everyone, and thanks for tuning into this webinar on navigating the UK broker landscape. I'm Dan King from Insurance Data Lab. Before I introduce today's lineup of panelists, I'm going to talk to Matt Scott about some new broker research that we've just published. Hi Matt, firstly, can you explain what this research is all about?
Some of the research that we've just published into broker performance. So welcome everyone, and thanks for joining us today. So we've been analysing annual company accounts to help assess the financial performance of brokers. And to be included in this analysis, a broker needs to have filed full accounts at Companies House for each of the last 3 years, as well as reported positive revenues and have at least 10 members of staff. In the research, we've calculated a percentage score for each broker across 3 key pillars. That's growth, profitability, and productivity. And then these have been combined to create an average overall performance rating for each broker. For growth, we looked at the change in revenues and profits over the last 12 months. For profitability, we calculated the 3-year EBITDA margin. And for productivity, we looked at staff costs as a percentage of turnover over the last 12 months and the turnover generated per employee over that same period.
And what are the results telling us?
So we analysed and rated 136 brokers in total, and across those brokers, the average overall score stood at 52.2% this year, slightly up from their 51.8% last year. And it's great to see such strong levels of performance, given the growing number of challenges facing the industry, some of which I know we will come on to later. The average growth rating has taken a bit of a hit. It fell by 2.5 percentage points over the last 12 months to 51.5%. But profitability still remains a high point for brokers, with an average rating of 54.3%. And that's off the back of an average 3-year EBITDA margin of 24%. Productivity has also been improving, with the brokers receiving an average productivity rating of 50.9%. That's up slightly from last year when it was 50.1%, and that follows an increase in the average.
And what about individual brokers? Have you seen any standout performers?
Yeah, so our research this year recognises 8 broking firms that have achieved top of our rankings, and the best performing broker in UK GI is Admiral-owned EUI with an overall rating of 73%. And that makes it the 2nd year running that the broker has picked up a gold award. Our other gold award winners this year are RAC Financial Services, JCB Insurance Services, General Insurance Brokers UK, Roanoke International Brokers, DCJ Group Insurance and Risk Management, Avantia and Payment Shield. And that's with RAC, JCB and EUI also picking up a gold award for the 2nd consecutive year.
Excellent. Congratulations to all 8 brokers. How can people find out more about the research?
So the report we published alongside this goes into more detail around the overall market performance and what the results look like for different sizes of broking firms. And it also includes an analysis of the top performing businesses. We'll be sending out free digital versions of the report to everyone watching via the next edition of our newsletter, which will come out early next month. But if you can't wait that long, the report is also available to download now on our website. And for the first time this year, we're excited to be offering tailored benchmarking reports. And these include a detailed analysis of your own firm's score across each of the metrics that we look at. And then we can compare these with how your competitors performed and also with the wider market. And if anyone would like to find out more about any of these reports or also our data insight platform, then feel free to drop me a line at matt@insurancedatalab.com, or you can also reach out to us via our website.
Brilliant. Thanks for that, Matt. I'd now like to introduce the rest of our panel for today. So please welcome Phil Bales, Chief Commercial Officer at O'Donnell Advisory, Peter Blanc, Head of M&A at Howden, and Nick Houghton, CEO at JMG Group. So before we get started, I just wanted to point out we'd like this discussion to be as interactive as possible. So please do submit any questions or comments you may have. You can use the Q&A tab in the Zoom screen, and I'll put as many as possible to our panelists throughout the session. So to kick things off, let's jump straight into one of the hottest topics. There's been a phenomenal amount of M&A activity in the broking world recently. Phil, given the levels of consolidation we've seen to date, do you think there is still a future for mid-market consolidation in the UK?
Yes, I mean, I think there is. I mean, there's constant announcements in the press about brokers who've been acquired, but I think sometimes the stand back is there's still well over 2,000, probably close to 3,000 independent brokers in the UK. They're a very resilient group of businesses, and there's also, it's not just brokers. There's other services or MGAs or other businesses which potentially are attractive to acquirers as well. So I think I don't see any reduction in volume. I think we were thinking probably 6 months ago that increases in interest rates would feed through, and that might just take the top off valuations, and that might mean that the consolidation just had peaked a little bit back end of last year. But then, of course, there's other factors are emerging as we speak. Definitely things I think prospects of a Labour government are focusing potential vendors' minds in terms of potential changes to things like capital gains tax. So we think that will lead to an increase in inquiries, certainly second half of the year. So there's no shortage of businesses out there. Vendors will have their own motivations and thoughts about when they want to sell, but there always seems to be a reason why now might be a good time. And so I don't think we're going to see any particular slowing up of the process.
Thanks. And Peter, how do you see activity levels progressing over the course of the year?
Yeah, I agree with Phil that the same demographics are in play. The majority of broking firms are still owned by, sadly, white middle-aged blokes who are approaching upper middle age. So there's a big retirement play that's still going to play through in the market. Yeah. And also we see a lot of brokers that are struggling to grow because they can't afford to necessarily invest to take on talent. They can't necessarily afford to borrow to then buy other brokers. So they find themselves a bit stuck. And if they've got ambitions for their business and they've got ambitions for their staff to do more, then actually sometimes a merger or joining forces with a bigger partner is the right move for their business. And then we're also seeing, of course, the constant drive of regulation. If it's fine when you're running quite a big firm, we've got teams of people in compliance that we can throw stuff over to. But if you're running a 5, 6, 7, 8, 9-man firm and you're then expected to pick up consumer duty, fair value, this, that, it must drive you mad. And actually we see a lot of that. Brokers are thinking, you know what, enough's enough. I'm going to give up on that front. I want to carry on looking after clients. But if I never have to do another RMAR return in my life, that would be great too.
Okay. And Nick, I saw this week, I think you've just completed your 20th acquisition at JMG Group. So with so much consolidation going on, what does this mean for the future of the smaller SME brokers that are left? Could it be that consolidation is having a bit of a polarizing effect on the market?
I think without doubt the market's polarizing. If you to Phil and Peter's points, it feels like sale by 1,000 cuts often. That if you take an average SME broker in the market, and even with a network, and the networks are good, even with the network support, the threat of digitization, attraction of staff, talent, succession planning, regulatory burden, insurers increasingly wanting more premium to have a relationship, etc., etc. I think it's no wonder that a lot of brokers are thinking of selling. You then put multiples, tax regime, change in government threats, etc. So I think all of those factors have been around for years, frankly. But I think we're now getting down to the level of the SME broker, and there are, as Phil says, still a lot out there. The one thing that is changing is we're all getting older, and so genetics kick in at or start to take an influence at a point. And I feel that that's a driving factor now that may not have been around sort of 10 years ago. So yeah, the market polarizing is only making it more difficult for the smaller broker, because insurers increasingly would like more premium, and it's difficult for a smaller broker, even in a network, to sort of provide that. And so I think we're in the phase which is the market. There's fewer brokers in the mid space. Bigger brokers, such as my peers here today, are getting bigger and bigger and bigger. We're in the middle, and there's still a lot of SME brokers to go at. So thank goodness.
And Peter, I saw you were nodding away there. So is there anything you wanted to add to what Nick was just saying there?
Yeah, I mean, look, he's bang on. I mean, as we say, there are loads of drivers, and we should all welcome M&A. I mean, one of the things that you often hear brokers say, "Oh, there's too much M&A in the market," but well, you say that right up until the point when you need there to be M&A in the market, when it's your turn, when it's time for your succession planning. And actually, we are very, very fortunate. Which is why there's so much keen interest from private equity and other investors to be in this space.
Yeah, okay. And the other big factor to consider, which I think obviously Phil mentioned just a few minutes ago, when looking at M&A, is company valuations. So Peter, do you think we're going to see these drop off a bit from some of the kind of heady hikes we saw last year?
As Phil mentioned, I mean, the interest rates rising, it has, and it logically should filter through to valuations. But I say kind of right now it hasn't yet, but it's certainly logically for private equity firms to make the same return on their investments, then logically they have to pay less for the businesses that they're buying right now, because debt costs are, for lots of our peers, debt costs are now approaching double what they were 3 years ago. So that's got to impact on valuations. But I'll say right now it hasn't yet, because there's still this supply and demand thing where there are a reduced number of mid-market brokers to go for. So on the one hand, you've got a lack of demand leading to higher prices, and on the other hand, you've got rising interest rates leading to lower prices. So there's a bit of tension there. I don't think it's filtered through yet, but logically, I think Phil made the right call. It's kind of the froth has probably come off the top.
Yeah. So I was going to come back to you, Phil, there, and just to kind of ask you, what's your view really on the role that the cost of money plays in determining valuations?
Yeah, but it's just as Peter said. I think there's many different factors play at valuations. Obviously, the attraction of that business, how people see the potential for growth of a business. Because it's one thing buying a business which is stable and hasn't necessarily got potential growth opportunity, but a lot of the businesses we see, and it was mentioned earlier on, is one of the things that potentially you access when you become part of a bigger business is more opportunities to grow. So sometimes you're looking beyond the value of the business now to what the value of the business could be if you were then able to allow that business to access the distribution that you have and some of the other attributes that larger businesses have to play with. But there is logically, as Peter said, there is a tie between, if it costs you more money, to borrow money, then in a sense you can't necessarily afford as much money to buy the assets. The same as, in a sense, it's the same thing as the housing market, isn't it? The reason why, but if the Bank of England puts the interest rates up, ultimately house prices start to fall because they become less affordable because of the cost of servicing the debt. It isn't a straight line relationship, and there are many other factors at play, and I don't see the market seizing up. But I think I congratulate Peter, actually. If you think, those who did a deal sort of second half of last year probably caught, in some respects, the absolute top of the market. But the market's still very, very, very robust, and there's always plenty of competition for good quality assets. So it's not that the market has in any way become stickier. It's just become perhaps a little bit more circumspect around the quality of assets that people are spending their money on.
Okay, thanks. And Nick, would you agree with that?
Brokers will always get a really good multiple for their business, and that's brokers that have got scalability, good processes, and you can do something with that business, and so I think multiples cannot keep going up because that's unsustainable. But the market, I think, is always going to be, with the amount of competition right here, right now. I think the market's this is going to, without this sounding too much like an advert, it is a terrific time to sell, and I don't see that changing in the short term.
Thanks. And Matt, if I can come to you next, private equity has obviously been a big backer of the broking industry in recent years. And having heard what the rest of the panel have just said, do you think it will continue to be such a driving force for deals in the sector?
And he's on mute. Love it. I love it when one of the hosts.
Sorry, yeah, do that every time. Yeah, no, absolutely, Dan. I think the private equity market continues, to see broking spaces having great potential, both in the UK and in Europe as well, where certain markets are starting to see activity pick up. And I think a lot of that appeal comes from the cash generative nature of broking firms, as well as the resilience that they demonstrate when times get tough for businesses. I think if you look back at some of the financial crises we've had and some of the tough economic times we've been through, the pandemic being a great example of that, brokers have generally demonstrated much stronger performance relative to many of the other industries that private equity firms back. And I think that's a great source of appeal for those backers. And I've spoken to a number of people at these private equity firms, and they definitely remain positive about the future of the broking market and the returns it can generate for them. So you there, Dan?
I am here. Unfortunately, my Wi-Fi is intermittent today, which is great timing. But Peter, do you agree with Matt? Any other kind of thoughts to add to that?
Yeah, look, I mean, the private equity guys, I mean, private equity is not a perfect market. They do have a habit of being a little bit like sheep sometimes. They sort of jump into a sector and they will carry. And I think we're probably in that space a bit at the moment. Private equity continuing to pile in, and some of the theses around why they're piling in don't really hold water anymore. The days of being able to build up a business by buying at 6 times EBITDA and selling at 15 times EBITDA, those days are gone. None of us, I wish they were still here, but none of us are able to buy businesses that cheaply anymore. So you have to be buying businesses with a proper plan in mind. What are you going to do with it? To Phil's point, how are you actually going to knit distribution together? How are you going to make the businesses you buy grow? You can't just rely on multiple arbitrage, buying at one price and selling at another. I think that was the late 2010s model of building value. The model for this decade is about building proper, sustainable, great businesses. And private equity sometimes don't get that, and they struggle sometimes to invest for the long term. I think they've got a little bit used to quick in and out, quick flips, 2-3 years, fill your boots at 8 times multiple, sell at 12. But I think anyone trying to do that model now won't work. You've got to be building something proper, sustainable, sensible, and resilient.
Yeah, okay. And Phil, do you agree with that?
Yeah, totally. And I mean, it's not just private equity. There's different types of long-term capital as well that I think is interesting in the market because of the reasons that were stated. It's very cash generative. It's been a very resilient business. You just have to go to BIBA to realise just how resilient and vibrant the insurance market is. When the rest of the economy perhaps is faltering, it doesn't seem to apply to insurance. I think that it's an investable market. And the businesses that have invested have done well. The models are strong, and I think we're lucky within the UK market to have so many high quality businesses. And as I say, it's not just a question of a broker buying another broker to get a bit bigger. For me, it's the interesting thing is knitting together different capabilities and specializations so that it adds to your business, adds to your client proposition. And actually, some of the things I said early on from our, one of the things we always look at is what can we do to support distribution? One of the things which is sometimes difficult for smaller businesses is to invest enough time and effort actually distributing their products and growing their markets. Whereas, bigger companies have got some in-house distribution that you can access very quickly. So that's all part of the mix. But I think it's an investable market, and in a world that's always looking for better returns, I think UK insurance broking is still attractive.
Yeah, and Nick, anything to add to that?
I think there's a relative statement to Peter's point in terms of it depends what you're going from and to, I agree. As you get bigger, it becomes more challenging to buy smaller businesses. I still think there is a chapter in this story around the consolidation of the SME broker, because those brokers will sell, back to the previous points, and somebody will buy them and stitch them together. And you know, so I still think there's opportunity, and I can still understand why you know, private equity loves this market. So I don't think we're quite done yet. And I know you're not saying that, Peter, but I do feel that consolidation of the SME play, and then how you digitize that, I think that's a really exciting journey, that, and one worth investing in with the right business. So yeah, I still think there's lots to go at.
Great. Okay. Now, just a reminder to everybody that's watching, we are taking live questions from the audience. So this is your chance to put a question to these broking M&A giants of the industry. So please do use the Q&A tab and ask some questions. We've got one here from an Australian broker who's asking, what's the impact of Australian brokers buying up in the UK market? And he's mentioning PSC, AUD, Steadfast. And he says in Australia, the broker networks are big buyers of independent brokers. And he's asking, is this the same in the UK? Phil, do you want to take that one?
Yeah, we don't. Well, I think actually, I don't think the networks tend to be buyers in themselves, but often the networks are linked by ownership or partial ownership to larger brokers. So, for example, obviously, Ardonna owns Bravo Networks, you know, and the likes of GLP own Hedron, and so most of the networks are linked. And obviously, I suspect they are a source of sales, but that isn't really the purpose. Certainly, it's not the purpose behind us having a network. The purpose behind us having a network is to help small and medium-sized independent brokers thrive. That's the point of the network for us. We do other work on M&A, you know, elsewhere. So I don't think you see necessarily the networks buying, but obviously there is a linkage in terms of the impact of Australian insurers or brokers buying in the UK market. Without sounding disrespectful, there is activity, and obviously it's always interesting to see, but it's relatively small, be a relatively small impact compared to the domestic acquirers.
Or the Americans, frankly.
Or the American. Well, I was going to say the American or American-backed private equity, or people like Brown and Brown buying GLP and all this stuff. So the Americans have really been the driving force for a long time. If you think about it, it's not quite the same now, but you've had a very strong dollar versus the UK pound. You had very low interest rates for a long time, so it really created a perfect storm to create the interest in the UK market. And as Peter has said, even though the dollar's not quite so strong anymore and interest rates are up, you know, the Americans are here and still like the market and the returns it can bring. So,
okay, and Peter, Nick, anything to add to that?
Yeah, I mean, like, just on the Australian front, I mean, it's really interesting. I think because of the geography of Australia, the dealer group method of distribution has become really popular in Australia, where you get a sort of central hub broker that then creates brokers dotted around Australia that are members of a particular dealer group. It's a really interesting model, and it's one that actually has never really taken off in the UK. And I think it's just a geography thing. You know, it's if you're in a small town in Australia and you kind of want to be able to deal with someone that's not a plane ride away. So that geography thing has actually helped to create that structure, but that hasn't travelled to the UK. And actually, we've still got a vibrant community of SME brokers, a lot of whom are members of, as Phil says, the broker networks. So it's a different distribution model born out of geography, I think.
Okay, thank you. Now, Nick, JMG has been very acquisitive since the group was formed in 2020. What is it you look for in particular in a broking business?
I was just going to say we're having terrific fun buying network members because the networks are not keeping them in and buying them. But anyway, that's a different debate. Again, you know, all these things are relative. These chaps on have done huge amounts more than we have. I think a good broker. What makes an ideal broker? It's about the people. I think it's only ever about the people. And I think, you know, geography, and I think we all like specialisms and niches and such things. You know what you're good at and be really good at it. But fundamentally, when it comes down to it, it comes down to, do you want to work with the people? A bit like a recruit. If somebody's on the market, do you want to work with them? And if the answer to that is yes, and they've got a good business, then, as we said before, they're going to attract the best multiple for their business and for their size. So for me, it only ever comes down to, do you want to work with the people? But our model is we want people to stay with us. We're not looking to buy out and lose people. We want people to come in and join us. So that's the driver for me.
Okay, thanks. And Phil, what things do you consider when looking at acquiring a broker, and how important are some of the financial metrics that Matt spoke about earlier? So things like, profitability, productivity, and growth.
Okay, I'd reiterate what Nick said. The right people, the right leadership, cultural fit is the number one thing, because you're acquiring. And I think, like them, we look to, generally speaking, tie people in for as long as possible. We don't want people to leave, because in a sense they've created the business and they can take the business on to new heights. So it's not for us as sort of the old-fashioned buy, strip out all the costs and just roll the business in. Is the opposite of what we try to do. And I think, and likewise, obviously Nick and Peter as well. Financial metrics are always important, because obviously they determine, in a sense, how much you can pay for that business. I think the most important thing is obviously the performance now is very interesting. It's what part of the multiple is based on. But for us, a lot of it's about the potential of the business. So what can you do with the business after it's arrived is actually of more interest. You're not just buying a business and assuming it will look like it looks now in 3 years' time. A lot of our business plans are to double, or even double and a bit more those businesses, not by working them harder, but by just exposing them to distribution and capabilities and strengths that they wouldn't have as smaller businesses. That's no disrespect to them, but there are advantages of size and scale and distribution that some of the large companies have. So if you put a really well-run smaller business into a larger business that holds lots of opportunity, and then you allow that business to make the most of that opportunity, you can really achieve some fantastic growth. And that's really our strategy. So in a sense, the financial valuation for me is based more on the potential of the business than what it is now. But clearly, you're looking for a business that's well run and solvent and doing the right things. That's the starting point. And then the second question is, and how much bigger and better could we help to make it?
Okay, great. And Peter, you recently took on the role of head of M&A at Howden. And as we all know, you've been involved in quite a few deals on both sides of the equation over the years. So what's important for you when looking at potential acquisitions?
Well, look, we will look at all types of businesses, because we are still buying up. For example, we have a big business buying up books of personal lines business from brokers that no longer want or feel able to look after the personal lines for their customers. Because personal lines is a real skill set, as everyone knows. It's if you're not in personal lines, you shouldn't be in personal lines. And we've got a business in A-Plan that is absolutely fantastic at personal lines. So we're buying up books of business, and with those, that's very much just a really straightforward financial play, where we will buy up books of business and just do a great job of looking after the personal lines for those customers. Next level up is the mid-market SME and community broker. Will they want to be part of us? Will they benefit from being part of us? And how can we help them grow? And then at the big end, it's then about the platform acquisitions. And that's where it gets really exciting in different territories and different geographies to look at where can we replicate what we've done elsewhere and make it work. So for us, it could be, is it buying an aviation broker in a particular country that's going to tap into our London market capability? Is it looking at a territory where there's still 2,000 or 3,000 SME brokers and there's a consolidation play, exactly as per we've done in the UK? Are there other territories where actually there are only a small number of brokers, but we can buy the best and then plug in our specialty capability? So it's really multifaceted. And I think our job is to be open-minded about what the potential is. And to Phil's point, it's all about what can we do with the business? What can we make it in the next 4, 5, 6 years? And the great thing about being part of Howden is because we're not listed, because we're not tied to any one external financial investor, we can take a really long-term view about these things. We talk a lot about a sort of 20-year vision about what do we want to be in 20 years' time. That's a really exciting place to be from an M&A perspective.
Thanks. And Phil, with O'Donnell Advisory, is there any particular types of broking firms you're looking at in terms of around specialisms that Peter and Nick have both briefly mentioned there?
Yeah, I mean, it's interesting. If I look back over the last 12 months, we've bought a real mixture of business. We've bought some fantastic sort of MGAs that are brilliant in niches that we know that we can help to scale through the distribution that we have. We've bought other businesses like Loriga, for example, that add real value-adding services on claims, post-event claims management and stuff. So, and we bought quite a lot of what I'd call real sort of sweet spot, nice small to medium size regional brokers. So there's not one type. I guess the things we most of all, you're looking for the things we've already discussed. You want a high quality management team, you want people who want to stick with you, and you want to see the opportunity to make that business become, fulfill its full potential. So it's not one thing. We typically, if I was to categorize the business we buy, they typically are what I call sweet spot, mid-sized regional brokers, and can be quite small brokers even, and also specialist businesses. But specialist business is a very broad church. That might mean they're fantastic at one particular industry niche, or it may mean that it's something that you can offer to your existing customer base that adds client value. So it can be all sorts of things. But these businesses have succeeded because they provide a valuable service to someone in the insurance chain. So we have a look at most things, but when I look back, that tends to be the two pockets that we tend to succeed in.
Okay, thanks. And Nick, from a JMG perspective, is there anything you'd like to add to that in terms of what you look for?
I think I would. I think we've said it all in terms of what the characteristics of what makes a great business, a great fit, and clearly it's different, subtly different for different businesses. So sort of going without wishing to go too far off piste, I would say that for people thinking about selling that may not have done it in the past, and so it's a big event. I think something that I say to people is, the money is great. Of course it is, but spend as much time thinking about when you're selling to a business, you're selling to people. So are you talking to the people that you're going to work with, or are they salespeople? Is the first thing. And really spend time thinking about, on that Monday morning when the cash is in the bank and you've popped the champagne, are you going to bounce out of bed and look forward to working with those people? Do you know who you're going to be working with? And I think that is one of the biggest questions, because the money's the easy bit in some respects. Valuation is on a spectrum that it's not huge. Are you really going to look forward to working with those people? And I think if you spend time reflecting on that, you'll make a good decision.
Okay, thank you. I can see everybody nodding away there, so I think that's
I agree.
the same for Peter and Phil. So, away from the world of M&A, Matt, can you talk us through some of the biggest challenges that you're seeing that are currently facing brokers?
Yeah, sure. So I think one of the biggest ones has to be regulation, really, particularly at the smaller end of the market. All well and good, maybe having a principle-based regulator that, to a degree, says it's up to each firm to decide, how they comply with these new rules and the new guidance coming in. But I think we do need to have more guidance from the regulator to help out. I'm not saying things like fair value and consumer duty should become a box ticking exercise. I don't think anyone wants that. I don't think that'd be good for the firms. I definitely don't think it'd be good for the customers. But I think the regulator does need to provide, at least some more guidance. So a lot at the moment, I think a lot of people are, to a degree, left scratching their heads, wondering what it all means for them and their businesses and how they go about complying with these rules. And then that's not even thinking about the workload requirements that comes with these new regulations we're seeing. If you're a broking firm that has a large number of different panel insurers and a wide product base, some of the rules around fair value is becoming unsurmountable, the amount of work that they're being asked to do. And I think something definitely has to change on that.
Thanks. And Nick, would you add anything to Matt's thoughts there?
I think, without doubt, regulation is a great thing. It's about looking after your customers and doing the right thing. So nobody can ever balk at that as a philosophy. Is it fair and proportionate based on the size of business? I'm not so sure. Do we as a market get behind Bieber enough in their talks and representing our market with the regulator? Probably not. It's a big driver for brokers selling, because it is very hard to navigate your way through that, even with like a network, which do some great support jobs, I know, in this area. So I think, will it change? Very difficult to answer that one. But I think, deep down, it's about doing the right thing. And if you do that as a broker, you're not going to go that far. The reporting's different, but I would ask brokers to get behind Bieber, and I would ask the regulator to say, is the regulation fair and proportionate in the GI space?
Yeah. Okay. Thank you. And Peter and Phil, you're both nodding again. But Phil, anything you want to add to that?
Well, I do worry that, I think you've actually got, if you look at retention rates that brokers enjoy, it's often in the sort of late 80s, early 90s. So, generally speaking, they are satisfying their customers. And I think they do a very good job and are very, very client-centric. So I do worry about, regulation that does make people so stressed about complying with it, they potentially leave the market and reduce competition. So it does worry me that we are there is too much of a regulatory burden. As I think what we're looking for is the exceptions. The danger is everyone gets caught whilst they're looking for the very few exceptions to people who look after their clients properly. So I'd agree. I think by any means possible, we should lobby for reduced regulation and making sure that they're hot on attacking those areas which are clearly abuses, but not hit the 99% of brokers that seem to be doing a very, very, very good job. And I don't think we've lobbied as effectively. We have had some examples of really good lobbying. So I think, Bieber did very well at managing the IPT, trying to keep IPT at a level rather than allowing it to go up to the same level as VAT. I think we almost need the same push around regulation again, because it doesn't seem to make sense to me. If regulation is supposed to be helping us serve clients better, forcing people out of a market because it's too strong and leaving just those people that can afford to invest in big compliance department feels as though it's an own goal. So I do think, I'll whisper it, but I do think we're in danger of over-regulating what is a very client-centric sector.
Yeah. And Peter, is there anything you'd like to add to that?
Yeah, I think the big thing that most of the harms in the market that the regulator has been trying to solve, in my view, can be laid fairly and squarely at the door of the price comparison sites. I actually think the price comparison sites, the existence of price comparison sites, when you think about it, when you reduce insurance down to a price-driven commodity, and the sellers of the product know that to sell more product, all they have to do is reduce the quality of the product, therefore they sell more, you get exactly what has happened. You get stripped out, poor value products, and the claims rejection rates that we see from the direct writers online are off the clock, sort of 40% plus claims rejection rates. That's the problem. And actually the regulator could, at a stroke, make life so much more simple by saying, clamping down on price comparison sites and acknowledging the fact that brokers that give advice are already providing fair value. To Phil's point, we wouldn't have 95% renewal retention rates if clients thought we weren't providing fair value. So we've just used a sledgehammer to crack a nut, over-regulating part of the market that's working really, really well, and not dealing with the actual root cause of the problem, which is price comparison sites, members of the public buying poorly understood products online in a price-driven environment. Rant over.
Thank you. And Peter, I know when you were speaking ahead of this call, you had some really interesting thoughts on some of the other challenges brokers are facing, particularly when it comes to placing complex risks. Could you tell us a bit more about that?
Yeah, I just think that it's been I think part of this is just the evolution of underwriting over the years has become increasingly data driven, and there's a big danger in that, of course, because there's a danger if you're an underwriter and you're being bombarded with all this fabulous data. There's a massive danger that you start to think, oh, I can cherry pick my way to glory here. I'm just going to pick the small subset of risks that I'll get shown that have never had a claim, are never going to have a claim, and I'm just going to insure them. And then anything else that's ever had a claim or is a bit hairy, then we're just going to walk away from. And we see that a lot in the market right now. It's maybe not that quite extreme, but we see extreme price competition for plain vanilla SME risks that are claim free issues. And that, creates real challenges for brokers. Actually just trying to get difficult risks placed is a real art form these days. And we're having to schedule risks like never before to get big risks placed. And I think a lot of that is just down to this cherry picking that's come about through the poor use of data.
Thank you. And Phil, I think you had some thoughts on kind of insurer service levels that you wanted to share as well.
Well, I think I was astounded, very surprised. The first thing I did when I moved over and joined Donna, especially as part of looking after the network, was going to speak to lots of the independent brokers out there around what was on their mind. And the biggest issue they had was getting responses at all from insurers, not just on trading, but also on claims issues. Now, that was, I guess, shortly after the pandemic. But I still think it's probably, it's certainly one of the major issues is actually getting service from a number of the larger insurers. There are some insurers who are absolutely getting it right and are growing very, very quickly on the back of getting it right. But the others, I would describe, the service levels generally are fairly, mediocre to middling.
Mm-hmm.
So I do think, and particularly and I think the point that Nick made earlier on and Peter's made is, it's difficult, there is this sort of 80-20 rule there, and I think if you're a larger broker, then it's easier for the insurers to spot them and to service them. If you're one of the 2,000 or 3,000, unless you've got, say, for example, a network very actively working on your behalf, it's easy for you to disappear off the radar. And if people have got limited resources, they'll basically service what's most obvious to them and underservice what's least obvious to them. So I do think there's a big prize for the insurers who get service right, and a few insurers are enjoying that big prize. And there's low growth or no growth for those insurers who aren't getting it right, which I would say it's the majority, but it's a decent number. So I still don't think we've really recovered properly from the pandemic, and I still think it requires significant investment from the major insurers to get the service levels back up to what they should do. And they're cutting their nose off to spite their face by underinvesting.
Mm-hmm. Yeah, and I think a lot of people that I've spoken to, I think Matt's spoken to, we're expecting insurer service levels to improve quite dramatically after the pandemic. Is it fair to say that's not really happening then, Peter and Nick?
I think a good litmus test is how many smaller brokers are using MGAs to place risks that they could place with the capacity provider. So are things improving? Yes. Are things good? I think they could be a lot better, and I think it's a missed opportunity for the market. As Phil says, there are some that are getting it better, much better than better service, much better than their peers. But brokers are simple animals. You look across that broker landscape, and especially as the market polarizes, SME broker, and there's nothing wrong with that, because that is the fundamental test as to whether a broker is successful or not, their ability to win and retain clients. And generally speaking, those businesses are not digitized, because the client phones the broker and speaks to the same person pretty much whenever they want. And the fact that as brokers sometimes we can't do that with insurers is just staggering to me. And so, you know, I think we should stick, as a market, we should be really careful what we wish for, because customers just at the moment, generally speaking, want to be able to speak to somebody and say, can you help me? Because the world of risk is becoming more complex. It's not becoming simpler, it's becoming more complex, and that requires more thinking. It'll slow down the digitization, in my view. So I just don't think we should ever lose it off our agenda. Have a person who can pick up a phone and sort a problem out when tech can't do it. And you know, and I make no apologies for being oversimplistic on that, because we're not very good as a marketplace.
Yeah, okay, thank you. Now, let's get a bit more optimistic. Moving things to a close, well, because we're starting to run out of time. So let's end on a high. Peter, what do you see as the biggest opportunities for brokers, and what advice would you give them to make the most of them?
Oh God, I mean, the world is absolutely full of opportunities. I think brokers are, we're blessed because what we sell is actually quite complicated, and barring even just apart from the most basic of simple motor insurance, but even arguably motor insurance, everything needs advice. Brokers are at front and centre of advice, and provided we're good at what we do, retain our service levels. To Nick's point, a lot of what we have to do, I think somebody once said, somebody much cleverer than me, to be great in insurance, you just have to be quite good. Which is a damning indictment in some ways, but you know what? It is so true. If you just provide decent, do what you say you're going to do, phone people back, call customers back, look after them, treat every customer as if it was your mum, and it's kind of really simple stuff, and actually just solve their problems for them. That's what brokers do, and I think that's what we've done for generations, and we will carry on doing it. It's a really exciting time to be a broker, but also incredibly challenging for all the reasons we've discussed already. Yeah,
and Phil, same question to you about the opportunities. What do you see out there?
I don't think Peter left much for me. But I would say, it's right. It's doing the basics well, day in, day out, looking after clients, and I think brokers do that. Brokers don't need me to tell them that. I think that's why brokers have got the successful business model that they have. I still think, and we've sort of all alluded to it, there are some opportunities that are there that most brokers can be better at. So I think things like classic like e-trading, how many brokers are really making the most of e-trading and the efficiencies that it gives, and I still think there's lots of people, both at insurers and in brokers, who cling on to managing very small risks, which don't really need huge amount of touch points, when there's lots of risks that do need lots of time and investment. Things like cyber are obvious. I think the whole move, if you think about it, the economy is becoming a lot more virtual and a lot less sort of tangible. So less bricks and mortar, but more liability risks. And I think our mindsets probably haven't quite caught up with that shift in the economy. So it still amazes me how cyber insurance remains a sort of minority sport when it should be a 99% sport in my view. So I think it's making sure that we adapt with the times. I think that would be my one critique of the whole industry, not just regional brokers, but large brokers, insurers. I think we're still a bit too slow to adopt the opportunities that the sort of digital era present to us.
Okay, thank you. And Nick, what are your thoughts on kind of the opportunities out there in the market for brokers?
I think it's a great time to be an SME broker, because there are just, if you've got options, you've got choices, you've got opportunity. And I think for an SME broker now, back to the point around service, it's a great time to go and win and retain customers, because there's a lot of businesses not delivering that service. So I think, grow your business through organic growth. Smaller brokers can provide a good environment for people to come in and grow a book of business, because smaller brokers are agile and dynamic and entrepreneurial, so there can be good environments for people to work in to go and recruit somebody. There's lots of SME brokers thinking about selling, so be brave and go and buy a neighbour, a competitor, a peer, and grow your business that way, and bring businesses together. And hey, if you're feeling a bit like it's sale by 1,000 cuts, and you're not that bothered about taking the risk, or you feel it's too great, pick up the phone, because there's lots of businesses that would love to talk to you about the next chapter. That doesn't necessarily mean the end. So I say, have a plan, write it down, and get on with it, because the next handful of years, there is so much opportunity in our marketplace for you.
Great, thank you, Nick. And it's good to start with M&A and end with M&A, because we've actually also got a question come in from Mark Flenner about M&A, asking, how do you compare your UK SME M&A consolidation strategies to those needed to be successful in continental Europe and Scandinavian insurance markets? And are we at the start of a new wave of M&A in those territories? Peter, you've got a fortune system there for investments, if you believe the press. So what's your view on that?
I mean, look, it's Mark is very right to say, look, there are different levels of consolidation activity going on across Europe. Some countries have been at it for years. I mean, the Netherlands have been following a very similar path to the UK. Germany less so, France less so. Yeah, but it's different in each European country. And one of the things that I've discovered so far is, the European Union, there is no such thing as one common approach. They are completely different markets, different approaches. I mean, in just as a for instance, in the Netherlands, the strategy has very much been to acquire small brokers and then put nearly all of the business through the broker's own MGA, which of course the FCA would take a really dim view of in the UK. If we just bought business and said, right, we're putting it all into our MGA, I think they might have something to say about that. It's a different regulatory environment. There are different levels of maturity, and our view and my view is that we need a plan per country, because it will be different in each country. And one of the differences that Howden have is that we employ French people to run France, German people to run Germany, Italian people to run Italy. We don't believe we know it all. We don't believe we know it all from London. And actually, we work with each country to come up with the best strategy for each country. Yeah,
thank you. And Phil, how does that compare, Donna?
Yeah, so we've got a similar structure. So the European, I'm I don't need to worry about the Scandinavian M&A market and someone else's opportunity. But yeah, so we've got a European structure. It's actually headquartered into Ireland, but obviously each country runs themselves. We've got Ireland, so we're not everywhere, but we do believe in the countries having their own strong management teams and working out for themselves what they need to acquire and what they need to grow. What we are trying to do more and more is, where there are things that work well within a group, is try to export things. But as you say, I mean, Peter's right. Fundamentally, each market is different, and you need people who understand how you win in each market, and that's what we do.
Thank you. And Nick, anything to add to that from a JMG perspective?
No. No,
Okay.
Know what you're good at and be really good at it.
All right, brilliant. Well, that brings us to the end of today's session. So many thanks once again to Phil, Peter and Nick for joining me and Matt today. And thanks to all of you for tuning in. Look out for our broker performance report. We'll be sending it out through our email newsletter early next month. And just as a reminder, what we do here at Insurance Data Lab is that we track the performance of insurers, brokers and MGAs across a range of different data sets that incorporate things like underwriting and financial results, solvency positions, customer experience and complaints handling performance. And all that data is available on our Insight platform. And if you'd like a free trial of that platform or would like to find out more, please do just get in touch with me at dan@insurancedatalab.com. Thanks again for watching, and thanks again to our panelists, and goodbye for now.